Thank you for joining us for our Consumables Pro Outlook. I'm Daniel Biolsi of the Consumables Pro team, and I'm joined with Howard Penney, our sector head. Howard, I'll turn it over to you.
Thanks, Daniel, and thank you everybody for joining us on our Consumables Pro update slide deck. We're going to run through a number of things today as it relates to the Consumable Pro product and what you're going to get. First, I want to introduce you to the team, which is on slide 3. Myself, covering restaurants for a number of years. Daniel, who you just heard from, and you'll hear more from him in a second. And then Kosei Suzuki, who is an English major at Columbia University and a critical part of our team. So what is Consumable Pro and what do you expect from us? On slide 4, essentially you are going to get the best of us in terms of our ideas, the money-making ideas, trading ideas, daily notes in each sector, and video summaries of our long and short theses, Q&A. We've done a number of Q&As, which are a lot of fun. Love to hear your questions, and as well, we'd love to hear your questions today. And we do have industry trackers and sentiment monitors that keep us updated through our process during the day. On slide 5, you can get an idea of what the emails look like across the 3 different sectors: restaurants, staples, and cannabis. So Daniel puts together a Staples insight, which goes through some issues in the Staples space. I do the restaurants, and then collectively, Kosei and I together do the cannabis insights. And those are really fun to do, frankly. It's a great way to start the morning in terms of keeping up with the news flow and understanding what's going on. And frankly, it helps us and drives our process from keeping up with our best ideas and any incremental data points that we should be aware of. On slide Y, Consumables Pro, for the serious investor who wants company and industry insights that professional investors have. Daniel has a number of years experience. I have a number of years of experience as well. And you're going to get the best of our earnings models, trackers, and as I said, decades of industry experience. But most importantly, we're here to help you make money, frankly. So what I'd like to do now is turn just to the restaurants, and then I'm going to turn it over to Daniel to talk about the staples, and then I'll come back and talk about the cannabis industry, which is really an exciting place to be, and frankly, some great loans in the space today. So on slide 8, you'll see the restaurants Hedgeye position monitor. We've got a lot of longs and long biases, and a few shorts that we've been focused on. Beyond Meats and Shack are our 2 best ideas in the restaurant space as short. And yes, I still love the short on Beyond Meat even after it has gone down today or down yesterday. And then there's a theme here that runs through the restaurants long. And about a month ago, we did a deck on a long casual dining because we think the recovery there is going to be strong, and there's a number of operators that are better off, frankly, which is sad to say, but true, and to a certain degree that this is the COVID experience has really forced them to improve their operations and the fundamental aspect of running their businesses. And so you're seeing these businesses better run today, more innovative, using technology to drive the business. And frankly, they have done things today they would have never done from an operational perspective to improve the business if COVID didn't hit. We do have some biased longs there, which to a certain degree I'm getting a little nervous about, given the way some of these stocks are acting, and those are the COVID winners. We do still like Papa John's and Domino's, but we're going to have to see how they begin to unfold in the first quarter. On slide 9, you can get a look at what the recovery timeline looks for a number of these companies. A little less certain. Play looks a little less certain, but we like Brinker and Texas Roadhouse, as you saw from the best ideas. But you get an idea of what the recovery looks like. And yes, if there is a vaccine, that might actually turn out to be the case for Play, a 324% increase. In comps 4 quarters out, but I wouldn't hold my breath on that one, frankly. On slide 10, you can see what the current industry sales trends look like through October from Black Box. There's been a nice recovery, obviously, as we've seen When you look at traffic, same-store sales down 7.5% and traffic down 13%, but it's starting to slow, and meaning that the rate of recovery is petering out, and that has a large part to do with the fact that dining rooms aren't opening, and they probably aren't going to open as rapidly as some might like, some being the industry participants might like, just because of the new outbreak in cases. So the recovery will probably stall out from here until we get into the first quarter and into March and April, when you'll begin to see some of the comps that you saw on the previous slide. On slide 11, there is going to be a lot of permanent closures. Sadly, this is going to be the case, but I think, and I will steal this line from the CEO of Cisco, who said there's going to be a churn in the industry, meaning that you're going to get some closures, people are going to have to close down, but there also is going to be, some new restaurants opening up, and ones that have closed will find their way back into operating. So this is a temporary piece of the industry having to deal with the COVID issues, but we're going to come back, and the industry is probably going to come back a lot stronger. As you can see on slide 12, what the virus looks like trending across a number of different states, and obviously red is bad. To a certain degree. On slide 13, how soon from now would you be comfortable to eating out? This has improved significantly, frankly, but with close to 50% are comfortable eating out now, or under a month. And frankly, I'm comfortable eating out as well, but as long as it's outdoors and not indoors, frankly. And then on slide 14, we've broken down the same-store sales, and we do this daily, frankly, as we get updates from different companies, and you can see it broken out: casual dining, family dining, fast casual, small box, and traditional quick service. And again, the casual dining has got one of the bigger recovery trends that we're going to see as we head into the second quarter. I am skeptical of playing some of these family dining names, so we're just going to stay away from those names for now, but you never know. So with that, Daniel, I'm going to turn it over to you. And
okay. Howard. So for consumer staples, on start off at slide 16, that's our position monitor. We can get into some of the specific companies in the Q&A, but this is where we stand with the various ideas. On slide 17, grocery sales have been one of the big COVID-19 winners, and you can see the sales increase over a long-term chart here below. And we're seeing a little acceleration here actually in September, with some of the restrictions coming back on with the states. On slide 18, we can see there are a lot of behavioral changes which are really important to understand on how and what the consumer was spending, but we're not going to get through all of those right now, but you can refer to those. On slide 19, I've been using fresh produce sales as a good indicator of what the real demand is, because there was so much stockpiling and buying ahead of demand by the consumer during the pandemic. But fresh produce isn't stored, so it's a pretty good indicator of what the home meal preparation is, and that's been quite steady since July. It's been about up 10%, and it's holding steady currently. And that's despite some people returning to work, some children returning to school, some people returning to the restaurant. It's still up about 10%. So I think that's an important thing to keep in mind when you're looking at the grocery trends. On slide 20, I put this in here. It has the top 21 categories that you find in the grocery store, and you can see the growth by channel. So you can see how it's the grocery channel itself has outperformed the convenience channel and the multi-outlets, which are like your big box retailers like a Walmart and Target. And you can also see on e-commerce just how much the growth rate has been in e-commerce, but it hasn't been in every category. Obviously, there's some categories like cigarettes that you just don't really buy online. On slide 21, this shows the different pandemic time periods by channel, again, in a different way. And you can see the acceleration of the penetration of online has really benefited the grocery channel and the multi-outlet, but you can see the strength has continued even in the most recent 4 weeks. On slide 22, e-commerce, which I was just referring to, has been the big pandemic winner. This is it didn't happen the same time as the stockpiling period in March, because in the grocery stores they didn't have as many slots to fill. So the timing of the growth in e-commerce was a little bit different, but that's something where you saw several years of acceleration in the penetration of online shopping. All happened this year, and you've made people who probably would, like your older citizens who probably would never have wanted to shop online, they were shopping online. So you saw a huge increase in online shopping, and that's been decelerating in recent weeks. But we've seen a little pickup in the most recent period ended basically for October. We saw a little pickup in October, and that might be with some more restrictions going into the states. On slide 23, we're not sure which way a stimulus will go, and I think this is helpful to see the timing of when the stimulus checks went in and the unemployment checks. So you can see the grocery did benefit. The whole CPG category benefited just like everything else. But even when they faded away or stopped, you can see that the demand's still held up. So if we have another stimulus, the sector is not going to benefit on a relative basis. They'll still helps them, but you're not going to see a big jump in sales. And on a relative basis, investors are going to probably play other sectors where you might see that spending show up, like in the restaurants, for example. And then slides 24, something else to consider with the new administration is if the federal minimum wage increases, you can see that affect different states, and groceries chains are almost always regional, so you have different impacts depending on where the companies are based. And with that, Howard, I'll turn it over to you on cannabis. I know that's where people are paying attention right now.
And you can see how excited I am about the opportunities in cannabis, my background. Anyway, slide 26 is our cannabis position monitor. And I just want to note one correction on here. Yesterday, we put Aurora as a best idea short. We should have put Tilray, but anyway, so the two best idea shorts, both Afria and Tilray. And then with a big change for us has been going a long bias on canopy growth, frankly. That was our first short, frankly, in the space. In mid 2018, when we launched coverage on the space, we were short canopy and a few others. And now they're transitioning. They're making the transition, frankly. So it's exciting to see, and that has implications for one of Daniel's favorite names, Constellation, as well. But we love AYR, True Leaf, IIPR, Green Thumb, Cresco. I mean, there's so much opportunity in this space as these companies mature, begin to throw off some significant free cash flow, have strong margins, and as you can see on slide 27, the projected U.S. legal market of the cannabis space is going to have a very healthy growth rate, frankly, over the next decade, whether we get legalization or not, whether the Biden-Harris team come together and provide some kind of legalization, whether it's the MORE Act, State Cat, State Back. I mean, who knows what's going to happen. But the fact of the matter is, this industry is going to see significant growth over the next 10 years, frankly. And one of the reasons why we're feeling a little bit better about cannabis, you can see on slide 28, the Canadian adult use retail sales is really starting to grow. I think we're close to a $3 billion run rate on an annualized basis now. And that's really healthy as they begin to open up stores in, along the provinces. And then, of course, Canopy has its own store base, which will certainly help them as well. A map that you all may or may not be familiar with on slide 29, the post-election legalization map. This is really exciting, especially the dark green, as the dark green moves its way across the United States and into more and more states. And I think, as we wrote about today, Texas is really looking at, the potential of generating some significant revenues, and that would be a really big state to turn a little darker shade green. And of course, New York has been talking about legalization for years and years. But again, as these states border one another, if you go back to that map, sorry, if you look at these states, California was the first to grow, and then all of a sudden the bordering states go. Well, we've got, New Jersey now, Massachusetts, a few states in the Northeast. So guess what's going to happen? Connecticut's going to go, Pennsylvania's going to go, all these states, New York's going to go. So in 2 years, I don't know, pick a number, when you look at the Northeast and New England, that's going to be a darker shade of green. And that will allow these companies to show extraordinary growth over the next 5 years, 10 years. So on slide 30, our 2020 election industry impact. Again, this is hard to know how this is going to unfold, but either way, I think we're going to get some significant movement on some piece of legislation this year, just because you do have a few states that were red in the red column that went legalized, and that's good for the conversation around legalization, and you're going to bring in Republican governors talking about it, and people in the House and Senate, more importantly, talking about it, Republicans in the House. So lastly, on the cannabis space, you can see what we think the market could be like, or how big the market could be. Could be a $40 billion market. Again, we do map this out by state, by usage rates, by adults. So we've got a fairly robust model on how we map out the market. We're not just throwing darts at a dartboard here. Colorado, what we're seeing actually, and we put Colorado in here as an example, as a spike in sales, and you're seeing this across the board. I mean, we could have picked any one of the 12 or 13 states that have been legalized rec for a number of years, and you're seeing a significant increase and significant run rate in rec sales across the board for all these states. So anyway, Daniel, I'll turn it back to you. We do have, I would note, in the balance of this deck, a number of slides on our best ideas. If you have questions on those, we can certainly refer to some of the slides that we have, but we provided you some of the slides that go to the to the institutional community as we present our decks to them when we come up with best ideas. So Daniel, happy to take some questions.
Okay, Howard. So the first question, I'll start with the most likes, is what various ETFs are best positioned to take advantage of growth in the space? And I'm going to assume that's referring to the cannabis space. And I would just say, from my standpoint, when they say take advantage of the growth, I've never seen growth for a new sector like this that we see in cannabis.
Yeah, no, it's extraordinary. And then the models are extraordinary, frankly, the numbers that some of these companies put up. Harvest was talking about last night, the average dispensary, on maturity in Nevada could be somewhere around, 9 million in the average unit volume. That's just an extraordinary number. And of course, in some recreational states, those numbers are even higher, significantly higher. So there's the MSOS, I believe is the ticker, is the one that's focused on the U.S. cannabis market. That's the one that Keith talks about in the morning call the most. Now that is a U.S. based ETF. So if you want to play the U.S. Companies, that's the best way to go. The MJ, I believe, is the symbol, incorporates the Canadian companies, and it's hard to know on a pure growth, right? You want more exposure to the U.S. than I think Canada, but if there is legalization, as you saw, with the performance of Aurora, I think up 150% in 2 days on the thought that there may be legalization. The Canadian companies it's going to be years before they are allowed into the market. So I want to focus on the U.S. companies, and so therefore, the U.S. centric ETF is probably the best one to play. But again, as if we get talk of legalization, everything's going higher, frankly. So I don't know if that answers the question, but I would focus on the MSOS as the one.
Sure. And Howard, I almost like IIPR, it's one of our best ideas as almost like an index play too, because it benefits from the whole industry. And if you just want to maybe take the most cautious way to play it from an ETF perspective, you also get a dividend with IIPR. And we actually have plenty of questions about them, but we'll get to, maybe I'll ask one of those questions here. What is our price target on IIPR, and when does it get overvalued?
I'm not, well, so we don't technically have price targets as part of our process. I would refer to Keith's ranges. If you want to think about targets, I would use Keith's ranges. At high end of the range, low end of the range is a way to think about it. If you're a longer term investor, this is a name that you just want to put away for 2 to 3 years, frankly. And it could, if you want to pick a number, it could double, because you now have 4 new states, which are opening up to the rec market, which means they are now markets in which IIPR's existing clients can go in and open stores, and they can participate in that growth. And then we're New York, Texas. I mean, there are so many other markets that open up. I mean, it's really just beginning the emergence. This is an industry, I have to keep reminding myself, this is an industry that's under prohibition or in prohibition, right? So you are taking advantage of investing in an industry, think about investing in the alcohol industry in the 1920s when it was in prohibition. I mean, it's just, there is just so much growth and potential here that, it's hard to pick a number. And like I said, we don't have price targets, but I would use Keith's model. If you want to trade it, the best way to do it is to use Keith's ranges.
Right. And we have slides beginning on slide 46 for IIPR, and maybe like a reminder for them is that it's a REIT. So, if the stock gets, overvalued, they can issue more equity and they can go out and invest more in the space, and then they can grow again. So in a way, it doesn't get as overvalued as like a tech stock, because they can use that currency, because right, as a REIT, it's a different structure than a C Corp, right? So they can issue equity and then they can go lend it to the industry and then they can generate earnings. So in a way, it kind of self-corrects the overvaluation. So you can look at it in a dividend perspective and say, well, this dividend might be low, but if the stock currency is quite high, I mean, they're effectively the only lender in the space, right, Howard?
Yeah, and if you want to enhance the returns, they can use the balance sheet, right? So, I mean, they're not even doing that yet. So there's just so many options for this company and so many ways to win over the next couple of years that if I owned it, I would not be selling it.
Right. Okay. Howard, are there any red flags you look for that are specific to cannabis companies' models, especially with regards to their IFRS reporting and inventory biological asset valuations and adjustments?
So the red flags, frankly, stem from management teams. And that is where we begin, frankly, all of our discussion with and thoughts around a certain company is management. And that's the single most important thing, because if you've got a reputable management team that has a great business model and they really want to create shareholder value, all the other things that were mentioned in that question about accounting irregularities or fair value adjustments, those don't matter effectively, right? And all those are modeled out anyway, because everybody looks at what a true cost of goods sold is. So if you really start with the management teams, and that's something that is hard because there are so many public companies out there in the space, and they all want to. The first 5 slides of every presentation is how big. Like we started with. The same way effectively with how big the industry is going to be and how big this state's going to be. And it boils down to, do you have a management team that can execute on the strategy, frankly? And so, I'll just go back to our initial, short thesis on Canopy. I mean, the guy that was running that was just, he he had zero knowledge, if I can say that, of cost of capital or return on invested capital. So and now if you listen to that management team, they are really focused on fixing the business, returns, and generating cash, generating earnings. So it really starts. I mean, I'll come back to what I said. I mean, it really starts with the management team, and if you've got a good management team, navigating this industry is a lot easier. Navigating the stocks is a lot easier.
Okay, and we also like to look at the states the companies are in, right? We like the limited license states. It's not maybe a red flag, but there are differences, and that's why we hope we can beat the index, right, Howard?
Yeah, no, absolutely. Yeah, no, I mean, there are, I mean, if you look at our longs, right, whether it's AYR, True Leaf, Green Thumb or Cresco, I mean, yes, they do have, well, Innovative has some cannabis, California exposure, but, we're not, we're focusing on companies on the East Coast, frankly, than more on the West Coast, but Nevada is a great state and there are some other states opening up. So yes, it's the limited license states, but more importantly, it's who's running those companies within those states, and have they bought the right assets in those states? And I suspect that there are some of the early MSOs in the space that may own some assets that they might not want to own today, but they were early in it and they bought some things and they want to upgrade some of the current assets. Who knows? But the limited license states, strong management teams and limited license states, and you've got a great long probably.
Okay, Howard, we have another cannabis question. Why would you go short Aphria when it is the low-cost producer in Canada, gaining market share, going into U.S. with Sweetwater, and it has a strong balance sheet?
Well, I'm going to let you talk to the Sweetwater acquisition, Daniel, because you know more about beer than I do. But I don't like that acquisition, frankly. And it's interesting to see. And I was thinking through this, in the last 24 hours, 48 hours since they made that acquisition, because, the Tilray CEO threw shade on the MSOs, right? And basically what the distribution channel for marijuana will look like, in 2 or 3 years. You've got Constellation going down the beverage route. You've got Irwin Simon taking Aphria down, the road of buying a beverage company in the United States. I'll let you speak to that in a second, but I've made a lot of money shorting Irwin, frankly, and I'll let you talk to the beverage strategy, what they're doing, but I'm not convinced that this is the right move for the company. But why don't you talk about Sweetwater?
Sure. And so I don't like the craft brewing acquisition. Maybe the person asking the question likes the Sweetwater beer better than I do. But what I'd say is, companies buying craft brewers have not had a good track record. There's very low barriers to entry. The acquisition price was much more expensive than Dogfish Head. I kind of went through the math, and we have it in a note of their profitability per barrel, and it doesn't seem to match with what they're charging. So I'm a little cautious about that. But at the end of the day, what are they delivering? Like when Budweiser buys a craft brewery, they're opening up their distribution. What is Aphria getting when they're adding Sweetwater? You can have your cannabis drinks, distributed without buying a company. So I think they're just trying to buy earnings without being able to support it. And there's sort of very little synergies involved there. We're not positive on THC drinks in the near future. It's not clear that that's a form that's going to take a lot of share in the industry. And then the other thing I'd add is that, Howard, being the low cost producer of cannabis in Canada is probably not that great of a claim when prohibition opens up. Canada is not going to be the low cost producer, right?
Yeah, no, and if you look at one of the names that's on our long bias list, it's a SPAC, Clever Leaves, and they're producing at 20 cents, 20 cents a gram, and so in Canada, you're not the low cost. You're a low cost producer in Canada, but you're not the low cost producer. So that's not a great strategy, frankly. And prices are still coming down significantly in the market as the competition and the supply of cannabis and the inventory issues continue to play out. And that's frankly one of the reasons why we're not going long canopy today, frankly, because we want to wait for more of the issues that the Canadian market has to deal with. They've got to work through a lot of inventory, which means prices are coming down, which means margins are still coming down. And if you layer into that an acquisition that doesn't make sense, it feels like this is a really good short, frankly. Okay. And and it was up a lot as well in the last couple of days on euphoria of legalization, and that's not going to happen for years.
Okay. Switching gears a little, we have a non-cannabis question. Can you update us on Grocery Outlet with the stock down today? Sure. So Grocery Outlet is a best idea long for us. And what I'd say, they reported great results last night. They doubled, the consensus earnings. Same-store sales were up 9%. The issue is the same-store sales slowed in Q4, which, of course is an issue, but it's what we were modeling. We were modeling deceleration, but I still think Grocery Outlet is best positioned of the grocers to be able to comp the comp next year and, in order to grow next year. So one, they have 10% square footage growth. They're going to open up stores in Pennsylvania for the first time. And, that's going to prove that they can grow in the country once they can open up new stores in Pennsylvania. And that's going to be able to lower their cost of goods. You don't have to ship goods all the way from California out. And it's going to open up new supplier relationships on the East Coast that they could ship back to the West. It's all about the deals, and opening up in Pennsylvania and getting closer to other food manufacturers is going to accelerate that trend for them. But we see several reasons why that's happening, and I don't view it as structural, right? So grocery traffic trends are slower in California. California lags the rest of the country, and I think that's because they have still some of the most restrictions on where people can go. Conventional grocers have benefited the most from being a one-stop destination during the pandemic, and so that's hurt Grocery Outlet. But that's going to reverse next year, right? Like, people have been limiting their trips. When we get a vaccine, that's going to change things. So, part of this for a Grocery Outlet is looking out to next year, seeing how things are going to change. With vaccine, consumer behaviors are going to change, and this still has the ability to comp the comp. And then finally, online sales have contributed about 3 to 4% up to same-store sales for the conventional grocers. So if you take that away from them, they're comping similar to what Grocery Outlet is. Grocery Outlet just can't do that. They have limited inventory of their deals. It's just too complex. People have to go to the store, and frankly, I'd rather they not do it. One, they can't do it, but two, it's margin dilutive, and so you're not going to have that dilution on Grocery Outlet. So I think of Grocery Outlet as this is a great entry point for someone who wants to own it and put it away for a long time. This is something that can grow at a 20% clip for a decade, right? So this is that type of a name, and you're buying it just because same-store sales slowed from a pandemic sort of boost to what's sort of a normalized basis. And if the economy got weaker, their sales would accelerate and everyone else's would get weaker. All right, so I think that's for Grocery Outlet. And we have a restaurant question, Howard. Can you explain what is happening with Beyond Meat and McDonald's? Aren't they supplying McDonald's, and why isn't that a positive?
That was an interesting day, actually, because the day started out with McDonald's reporting a good quarter, and then they had their analyst meeting, and they introduced McPlant. And of course, there was no mention of Beyond. They no reason for them to have mentioned it, frankly. And then, so Beyond, then the stock goes down, and then all of a sudden, someone from Beyond says, "Oh yeah, a Reuters reporter must have called Beyond, and they got a quote saying, 'Oh, we were a part of it,' but they're not on the the menu, meaning the Beyond Meat or the Beyond Burger is not on the McDonald's menu. And I think, and then that evening we had the earnings from Beyond, which were disastrous. And, and one of the first questions was to the CEO, what's the deal with McDonald's, frankly? And of course he can't comment because McDonald's didn't comment. So he can't say they're on it, they're not on it, they're a part of it, they're not a part of it. But I think one of the issues here is, the CEO of Beyond has promised the street, I think, and I'm saying that to a degree because he's talked about, the relationship with McDonald's, and they tested the product in Canada, but only for 3 months, and it didn't work. And I to a certain degree, I think he's been telling people or whispering people's ear that, they're going to ultimately get on the McDonald's menu. Well, maybe he doesn't know McDonald's very well, but name me a brand that's on the McDonald's menu that doesn't, have a Mick in front of it, right? And the only one I can tell you what it is, right? It's Coca-Cola. So McDonald's will never put Beyond Meat on their menu. They might sell some technology to McDonald's to help them produce their burger? Yeah, but Beyond Meat will never, or the Beyond Burger, that name will never be on the McDonald's menu because McDonald's has never put, why would McDonald's put someone else's brand on their menu? It's not like McDonald's needs the Beyond brand for them to be successful. So it was an interesting day. There's still stories about it, as to what's going on, where the confusion is. And frankly, the only confusion would stem from, what the CEO of Beyond has told the street prior to this announcement, right? If he's promised people that he was going to be on the McDonald's menu, then, that's a promise that he just can't keep. So it's, Beyond is, way, it probably trades at 7 or 8 times sales. Sales are growing 2%. Margins are collapsing. The TAM and now we know the addressable market for the U.S. Food service industry is significantly below what the company wants you to believe it is. And, we have a deck on it, and I think there might be a slide in there. I don't know if it's in there or not. Hang on, let me just check. Yeah, so slide 38 would be our, what we size the opportunity for the U.S. plant-based TAM, and the Beyond thinks it's $35 billion. We put it in the $500 million to $4 billion range. So and this company still trades at a market value above that. Now, yes, they are in 80 plus some countries around the world, so the TAM does go beyond the U.S. But frankly, it's just not. I'm going to repeat myself, but one, they're not going to be on the McDonald's menu, and two, this just shows you. And McDonald's isn't alone, right? Yes, Burger King has put the Impossible Whopper on their menu, but Burger King needs the help, right? McDonald's doesn't need the help. Will Wendy's put Impossible or Beyond on their menu? Yeah, probably not. So I just don't think these quick service restaurant companies that are well run, right, and are doing well, don't need the Beyond brand on their menu to be successful. And I think that's the one part of this Beyond story that the company's been promising that just won't happen, frankly. And McDonald's is very clear about that, or is now very clear about
Okay.
that.
I don't know if there's anything else you wanted to add to Cleverly's, but that's the most asked question left. Just want to make sure I hit on the most popular ones. Is there anything else you needed to add on Cleverly's?
Yeah, so I'm really intrigued by the Cleverly story, frankly. I think there's a lot of attributes to that story: the low-cost production, the capacity, their ability to sell into Europe, into Germany. So there's a number of there's a lot of reasons to like that story, frankly, and it's a SPAC, so there's the issues around that. But we've had 2 different conversations with the company. We're going to have another conversation with them. Actually, it was supposed to be today, but it's going to be put off till tomorrow. So I'm still working through the process of where we're going to come out on this. But they have again, upon legalization, They've got a ton of export capacity in Colombia where their grows are to become a very big successful cannabis company. But yet, the path of the revenue growth is still unclear in my mind. So that's sort of kept me on the sidelines. And frankly, I would, I'd love to see them sign a long-term supply agreement with somebody and have the stock go up 20%, frankly, and then buy it. But I'll work through that myself. But I love the story. I think there's a lot of opportunity there, but we just got a little more work to do.
Okay. All right, I think we have time for one last question, and I'm going to combine them to the extent I can just to get as many answered. What happens to IIPR if the Safe Banking Act passes, and where do we see the biggest risks for the IIPR business model? I think those are directly related, but I think we have a whole deck that we can make available to them that goes into greater detail if they want. Howard, how can they watch the IIPR deck that we did?
Yeah, so we posted a link to to the IIPR deck in the Consumables Pro website, right, or the platform. So you can click on it and watch it. And to answer the question. And by the way, you can go on the Hedgeye website and subscribe to Consumables Pro because we are now having our best price of all year that you'll get it for, I think, until the end of the month. So anyway, getting back to IIPR, I'm not convinced that, lowering the cost of capital in the SAFE Act is going to hurt Beyond, frankly. There's a pretty good moat that they have around their business today. That will, first, legalization is years off, right? So that's not going to happen tomorrow. And what it looks like. But I think, the point that we talked about before about leveraging their balance sheet to enhance returns is probably the biggest reason why, one, the moat, but two, they've got this balance sheet that they can leverage to enhance returns and frankly drive the stock price up 2x from where it is today. So I'm not convinced that a SAFE Act is going to hurt them. Now, will it hurt it? Will the headlines hurt it? Yeah, probably it will. But I don't think it will fundamentally change their business model to where we're going to have to say, oh no, we don't want to own this stock anymore, or the story's changed, frankly, because if you think about the underlying dynamics of the industry, there's still a lot of need for the company to, or capital. The industry still needs a lot of capital. They will be a source of capital for the industry. And again, they have this tremendous balance sheet. I don't know if you want to add anything to that, Penney.
Yeah, I think you explained it well. I just pictured for someone who doesn't understand the story as well, if the rents are compressed a little because there's some more competition from other banks, if the SAFE Act passed, the company can borrow more, right? And they lever that balance sheet. So then the levered returns would be able to more than offset any rent compression. I mean, rent yields are not going to go to, tiny minuscule levels, right? And then they still have all that growth ahead of them. So they've purposely left their balance sheet unlevered for that day to come, but it's not coming. We did a call, I think last week, right, with our Washington experts on how that will lay out, and it's quite unlikely. We'll see in January how Georgia goes, but that's not the biggest risk for them, and I think that was taken off the table, and that's why the stock performed so well right after the election.
Yeah, I mean, because we have our 2020 election industry impact slide 30, which is still, red, frankly, and that means that it still favors the business model.
So maybe we can tweet out, we can send a tweet about how to get that IIPR deck, and that might answer those questions. But they can also visit our Consumables Pro landing page.
Or you can email consumablespro@hedgeye.com and we can send it.
Okay. All right, I think that's all for the questions, Howard. I don't know if you want to send us off.
Thank you all. Again, we're having the best price we get all year for subscribing to Consumables Pro. I hope you see that we have and will continue to generate a number of ideas to help you all make money. So again, thank you for tuning in. And Daniel, thank you for asking those questions or for moderating the question. And we'll talk to you soon.